G'day all. Welcome to today's webinar for Market Matters. I'm James Gerrish, lead portfolio manager at Market Matters. Great to have so many on the line today, and I'll bring in Shawn Hickman, who will be joining us. Shawn's the research lead at Market Matters, and we'll go through some of the key discussion points in the market. A heap going on. Shawn, how you going, mate?
Very well, James, very well. And yeah, it's a fascinating time, isn't it?
Well, we say it all the time, and I think it's been the last 12 months has been a lot of interesting, somewhat, at times concerning things in the market. There's a instability over in the Middle East that we'll cover shortly, and tie that back into actionable insights around the market, because a lot of the headlines that you see don't necessarily flow in directly into what's playing out in the stock market in terms of our investments. And what we're trying to achieve from those investments and portfolios. So we'll give you some clarity around what's playing out at the moment, the macroeconomic backdrop, and then we will dig into some stock calls. Just a quick overview of Shawn and I. For those who have been on webinars before, you'll understand that we're both well experienced in the markets, 20, 30 years plus experience across direct investments in equities, fixed income, trading. Shawn's previously Goldman Sachs, Macquarie, and we'll draw on his experience in today's webinar. Quick disclaimer that any advice provided today is of a general nature only. So that means we don't take into consideration any one person's personal circumstances. So general information only. Just a quick slide, as we do at the start of every webinar, just outlining our investment process at Market Matters. We describe ourselves as top-down meets bottom-up investors. We have a real clear, we try and deliver a clear roadmap on our views around the macro environment, how that feeds into sectors, and then we look at stock selection and then how those all fit together in portfolio construction. Today's webinar, it's going to be short and sharp. It's going to focus on markets, the current state of play. We'll look at quick look at markets versus the economy and what's actually being priced into equities at the moment. Positioning going into FY26. So we're going to focus on three key areas today. Uranium, really topical point. Technology, been topical for a while, and we think it's going to continue to be very topical in the years ahead. And then metals and mining. So some of the metal areas and the resources that we like, and then we'll have time for some Q&A. So as I said before, really chuffed to have so many of you on the line today. There's been great demand for this webinar. So if you're new to Market Matters, I hope you get some insight into the way we deliver content, the insights that we've got. For all our wonderful members out there who have been with us nearly 11 years, Market Matters has been going. So and many of you have been along for that whole journey. So thanks for your continued support. And Shawn, I've just started off here with a chart of the ASX 200 just to set the scene of where we are at the moment.
Yeah, it's hard to imagine, James, that we're actually up best part of 5%, 4 or 5% so far this year. It's if we look back in April, I think everyone was scared that the world was falling apart. And now suddenly we stand here, the market's knocking on the door of all-time highs. It was trading at fresh all-time highs last week. But we took a little bit of risk off the table yesterday, just on a simple risk-reward perspective. Looking forward, the market, a lot of the sectors, a lot of the stocks are very rich up here. And, on balance, the next 5% feels like it could easily be on the downside. There's a lot of good news built into the market around the Middle East. There's a lot of good news built into the market around interest rates. We'll touch on both of those later. And if we just look back at the seasonals, sometimes I like to talk about statistics, hopefully not too often. And, historically, June is a very choppy time, and we're already seeing that at the moment. The market's pulling back after a stellar May. And we're already seeing what happens next. July is historically the strongest month of the year over the last decade. July's been up 3%. So, we're still bullish into Christmas, but I think it's going to be a 3 steps forward, 2 steps back perspective. And one has to be far more pedantic in what you buy at the moment. The market's just bounced 20%. And I think that stock and sector selection is really going to be important moving forward.
Yeah, exactly. There's some stats on the screen there just that you'll be seeing just around market valuations. Now, we're trading at a 19.4 times PE. So that's for the ASX 200, which is historically high. The historical multiples around 15.7. I want to stress that the composition of the index has changed over that time. So the composition of probably our index to a lesser extent, but the US, which I'll get onto shortly, is more proportion to higher valuation stocks that will grow quicker. So therefore, they should be priced on a higher multiple. So there is some ramifications around that. But I guess the key takeaway, and you can clearly see it on the weekly chart of the ASX 200. We're at a high point in the market. We can continue to push higher, but we're just a little bit concerned about overall market valuations. You look at the index EPS at the moment, earnings per share at the index level. So these are what we've historical at 439.91. That's the earnings per share of the index, if you like. And then we've got estimated EPS. So the estimated EPS looks at 1 year forward. So it's FY26 consensus. So all the analysts aggregate their expectations for all the ASX top 200 companies, and you get out with a earnings growth rate of 1.1%. So that's we're reasonably highly valued. Earnings growth is relatively subdued. These numbers will change come August because we've got full year reporting season coming up. And then you think about the backdrop from an economic standpoint. So Aussie growth is running around 1.3%. That is expected to improve, but it's still relatively low levels versus 10-year average at about 2.4. The big one is inflation. Now, inflation's come back into the RBA target band. That's headline inflation at 2.4. If you look at the trim mean, which removes some of the more volatile items, it's still tracking at 2.9, which is within the RBA's target range. And we've got interest rates at 3.85%. So while we're bullish in the medium term in equities, is obviously the tailwind of falling interest rates. So we've got this situation where growth is okay, unemployment is okay, inflation's back into the band, and it really opens but growth isn't. Growth needs some support. So the RBA is still restrictive in their policy settings. The things that I've just outlined above, which would suggest that the RBA could be more accommodative, and that's why we believe interest rates will go lower from this 3.85% handle. The US as well, similar sort of chart there, Shawn.
Oh, it's almost identical, James. You know, they fell 20%. They've bounced back most of the 20%. Their composition is more growth, as you rightly pointed out. They had a few interesting comments last night out of the Fed, but the press is regularly very negative towards President Trump. But at the moment, he's enjoying telling everyone the share market's trading near all-time highs. So yeah, there's a lot more coming through. Once we sort out the Middle East, once we get the tariffs out of the way, then we should be getting the sugar hit from the new president. We should be getting the deregulation, and we should be getting the tax cuts. So there's a mixed messaging going forward, but it's not all negative around tariffs.
Yeah, I get that. So I think that's why we, the message yesterday with the alerts that we sent out was all around, it's a little bit more 50-50 here. So you put a bit more flexibility back in the portfolios. I won't run through all the stats on the US market, but it's a more highly priced market, but it grows at a quicker rate. US growth running at 1.8%. That was actually downgraded last night by the Fed's projections down to 1.6%. Their inflation is running at a level that's okay. They've got a 2% target on inflation, but that won't stop them from cutting interest rates, and they're cutting from a slightly higher level as well. So for us, the market, obviously the index is only one part of the market that we need to look at. The sectors within that index are really important, and then more important still is the underlying stocks that we own or avoid, and how they combine into a portfolio setting. We've obviously had a lot of headlines, Shawn, and if we go back to just what played out in the tariffs, one of our base case view on tariffs was that they're a strategy rather than a policy. As a policy, they didn't work. And I think that was clear for everyone to see, even Trump. But as a strategy, as a negotiating tactic for the US to get a bit better deal, they have worked. So obviously, the huge amount of the spike up in volatility, but we're really not seeing any market concern, market fear, Shawn, coming from the Middle East.
Oh, not remotely. Let's look at there. We're still trading around 20 in the VIX, which is where it's been, for the last 10 or 15 years, bar the spikes, as you rightly say. And I think what the Middle East is looking at is people are saying, and we wrote about it this week, in the next week or two, the Middle East will probably be, fish and chip wrap paper. It looks like.
Let's hope. I mean, it's
I think we all hope
yeah.
so. Let's hope there's not much loss of life. If you the more you read about it, the more fascinating it is. But the likelihood is that America will get involved. Hopefully, we'll get a negotiated outcome. It does feel less likely. I'm not a political expert, but it looks like the US will probably get involved, and the whole thing might well be over within a few days. History says that's what tends to happen with conflict in the US if America gets involved.
Yeah, exactly right. So let's delve into, last night was actually pretty fascinating. So the US Federal Reserve kept rates unchanged as was forecast by the market. So there was no surprises there. They did tweak some language around inflation, and they did lower they lowered their growth projections. They increased. So their growth expectations went from 1.8 to 1.6%. This is for 2026. They increased their unemployment projections from 4.3 to 4.5, and they also increased their inflation expectations mildly from 2.2 to 2.4% as well. So what was your takeout from last night's Fed meeting?
I thought it was very interesting, to use the word you used before, mixed messaging. In terms of the economy, they're saying it might be a bit softer than we thought. In terms of inflation, they're saying it's a bit higher. They're still saying 2 rate cuts. But my take, James, was I think there's far more chance of 1 rate cut than 3. I don't think 3 is a possibility. I think that they'll give us the 2 they're saying, but I do think there's an outside possibility. The market's saying it's less than a 5% chance, but I think it might be nearer a 20% chance. We only actually get 1 rate cut. They're quite happy to kick the can down the road and say, well, things are still a bit uncertain. They said that again last night. And when they're uncertain, and if they think inflation might lift, they will err on the side of caution. And I feel that the best case scenario is now built into the market with rate cuts.
Yeah, and this is what the market has built in, is right on the screen in front of you. So this shows the likely, or the market's pricing of interest rates over time, how that's changed over time. But ultimately, the market is expecting a nice gradual decline in interest rates, which has been supportive of asset prices. One of the things that I took out of the Fed meeting last night was that the board seems to be split. Those who think that tariffs, etc., will create inflation, and they should sit on the sidelines and wait to see how that all plays out. Obviously, Trump would like them to cut rates. They're being pretty stoic in not cutting rates at this stage. And then there's others within the Fed, and you see this in the dot plot, that think the tariffs, if they are inflationary, it's going to be transitory. So they should look through that, and they should be cutting rates. The important thing, if we look into 2026, is that Jerome Powell has obviously been a bit of a thorn in Trump's side, hasn't cut rates as he'd like him to do, but his term expires, I think it's May in 2026. So that's going to bring in the chance for Trump to put in someone who's more dovish on rates, so is more likely to cut rates, is more likely to do what Trump wants them to do. So that's going to be, if I look out the next couple of years, I still think rates are probably going to be higher in the immediate term for the rest of 2025 than perhaps many hope they would be. But going into 26, lower rates, Shawn mentioned the deregulation, lower taxes, etc. That is actually a really stimulatory environment for equities, and equities should do. That's why we're maintaining a bullish medium-term stance towards equities. So that's going to be something really interesting that plays out next year in 2026.
Exactly. I use the phrase kicking the can down the road. I think rates are going down. I just think it might be slightly slower than everyone's hope. I think the risks are there. It could be slower.
I'll put this chart in here. This is just Aussie interest rate futures. So this is where the market is expecting Australian interest rates to go. I've also pulled out UBS forecasts. So we do utilize UBS research, and there is you can see from the blue line what UBS are expecting. The market is expecting more rate cuts in a quicker fashion than they are, but the trend is pretty clear, right, Shawn? Rates are coming down here locally.
Oh, exactly. And 3% all over them, give or take. I think we'll probably get more than what UBS believe. I think that Michelle Bullock has now got off the fence, and she said, yeah, we're going to start cutting rates. And I think we could get a couple into Christmas at the very least, if not the third.
Yeah, I agree. I came off the press conference post the RBA last RBA meeting, and they've turned a lot more dovish. Inflation was obviously the major concern for them. That's now well and truly within the band. And if you look at the RBA's economic forecast, they've got inflation staying at these where they want it to be. They're pretty negative on growth. They think unemployment's going to tick up, etc. So to me, that opens the door for interest rate cuts here locally, 3 this year and perhaps more going into next year. I'm going to jump on. I'm going to jump on to the Market Matters website now. And start working through some of the areas of discussion in today's webinar. So those not familiar, this is the dashboard of the Market Matters website, looks at stocks that we've recently spoken about, gives a list of all of the Market Matters portfolios there, and goes into some data. And we'll try and do our best to show you around this website as we talk about things today, Shawn. I'm going to start because I think uranium has been a very topical area of the market this week, and I'm going to get on I've got the uranium futures chart there.
Exactly. And we wrote this week, uranium is, we're huge believers of Market Matters that uranium and nuclear going forward is a future for a lot of countries. We all know it probably won't be in Australia, but we have to look at the global bigger picture. Uranium's had a simple pullback. It's at a 40%, 40% pullback in price. Some of the stocks pullback was far more dramatic, especially on the local front, but it's turning back up now. We're seeing greater and greater adoption by some very big leading tech firms as they decide to shore up the power they're going to need to drive AI. And obviously Donald Trump is very much on board. We saw the raise earlier this week by Sprott, which you're going to go into. I can see the uranium price surprising a lot of people on the upside, most definitely not on the downside.
It was really interesting. I think it's a major change that's played out in the last week or so. So the Sprott Physical Uranium Trust is the world's largest traded security of physical uranium. So they have about 66 million pounds of uranium. They store that, and they have securities on the back of that. Just to give you some history, and I think this is important, so bear with me. In terms of this vehicle, it's been trading at a discount to the NTA, the net tangible asset backing of the fund. When that happens, they can't issue new units in it, so they can't raise any additional capital. So they've been out of the spot market for the last 6 months or so. So they haven't been able to participate in the spot market. There's been this, I guess, hedge fund trade put on over that time period that suggests that they've got some reasonably high costs to operate this trust. So what they need to do is raise money each year, but they can't raise it unless it's trading at or above NTA, and it's been trading below. So those hedge funds have been trying to pressure this vehicle, if you like, which this week that has changed. That dynamic has changed. The vehicle is traded above NTA, which has allowed them to raise capital. They were going to raise 100 million US. They raised 200 million US, so demand was high. So they can now go into the spot market and buy physical uranium, which is going to be supportive of the spot price. And I had that spot price on the screen just before. That doesn't mean that immediately they go in and buy pounds. It just means the market can be supportive from there. The other thing that I'd highlight is that over the course of the last 12 months, uranium, the majority of uranium is priced through utilities, and utilities do term contract pricing. So, a mine that's producing uranium, they'll sign a deal with a utility at a certain price over a certain period of time to deliver pounds of uranium. They're not trading in the spot market, so it doesn't change the actual immediacy or dynamic of the market instantly. But now that there's more pressure in the spot space, it'll entice utilities back into the market, which they've been fairly lackluster over the last 12 months. So I think it's a game changer in terms of uranium. I'm going to bring up Cameco. This is a stock in the largest uranium company in the world, Shawn. So this has been, if you want to look at a happy place in uranium, Cameco is a happy place. We own Cameco in our international equities portfolio. Take us through this one, Shawn.
Well, you've just mentioned that, James. We own it in our international portfolio, and it's one of the reasons why Market Matters will be launching, you might talk about this later, James, an international portfolio, hopefully in the very near future, because it gives you more options. This is company, it's very simple. It's trading at all-time highs. It's operationally very solid. It looks fantastic. And to me, I don't see any reason why you wouldn't be buying that into any dip. I'd be interested to know, and we won't ever know, we all know that there's a huge short position on the ASX miners. I wonder if they're offsetting that with long Cameco or long some of the uranium ETFs. That's something we'll never know. But I can't see any reason why one would be short the local ASX miners, even if they have got a habit of missing every opportunity they get.
It makes total sense. So you buy the strong operational performer, and that's been Cameco, and you short the poor operational performer, and that's been Paladin. So Paladin have had several issues this year just around the ramp up of their Langer Heinrich mine in Namibia. They also doubled down and bought Fission over in Canada during the year. So they've gone harder into the uranium space during this market turmoil partial market turmoil in the space. So they're more leveraged to uranium. I think it's just a matter of time before these uranium companies locally start to catch up to what we're seeing overseas. And I think there's the combination of the spot market moving, which is a positive read-through for the uranium equities and sentiment in the uranium equities, and dovetail that into what we're seeing in terms of, Shawn made mention of it, large tech companies. They are contracting nuclear power for long-term use. This is going to power AI. So if you like AI, you think data is a thing of the future, then uranium is going to be one of the key areas that will power it. You can have a look on the Market Matters website around financials. You can get all bunch of information that you'd like. You can read all of our opinions that we've written on Paladin and every stock that we cover, and then a history of all our actions around that. So we're very transparent, very clear at Market Matters around our views in the market on individual stocks, whether we're holding it. We hold Paladin in our active growth portfolio, and we are down. It's one of our worst performing positions, and it's been a negative for our short-term performance. So I'll just put that out there and be clear around that. But we think it's got some great upside over the coming 12 months, and we're sticking with it. And we've running a 4% portfolio weighting in Paladin. Does that wrap up uranium, Shawn?
It does. I just want to reiterate the fact that when a uranium stock starts to go, it really goes. So, for example, Boss Energy this year in ASX name is up over 90%. So at the moment, Paladin's in the naughty corner. When it breaks out of the naughty corner, I really think it could be like a champagne cork popping. And as you alluded to before, James, it's leveraged itself up into uranium at a very good time, in my opinion. The market just hasn't got on board yet. But when it does, I think it's going to really, really go.
All righty. Okay, so that is uranium. We're bullish on uranium. We own Paladin, we own Cameco, and in the space, and we think the overall thematic there is a good one. Technology, Shawn. Let's get on to some technology that everyone is speaking about. We actually wrote about some technology stocks in the AM report today. You'll find all the Market Matters reports on the site, and you can either read it in long form or you can read it in short form. The short form is just our actionable insights from stocks that we've covered in the morning note today. So let's get on the tech, Shawn.
Yep. So as you say, James, we took profit yesterday on Zero. We've held that for a few years. It's a company we like. We were fortunate enough to take over 90% off the table, and I can imagine a lot of people say, "Oh, you're just grabbing the winners and you've let a loser like Paladin fall away." That's most definitely not the case. We reiterate, we like Zero. We recently bought WiseTech into its aggressive sell-off, so we've still got a fair bit of tech on board. but we just feel with the zero knocking on the door of $200, however good the company is, it's limited upside, it's very rich, and we were just happy to take a bit off the table, as we said, in terms of the whole market. And Zero is a stock that James and I have been talking about for a little while around that same issue.
So you jump on the Market Matters website and you'll see when we put out the alert for our active growth portfolio, you get an SMS plus a email alert. For the other portfolios, you get an email alert. But you can come and jump on the site and you can see the alerts that we've got in place. We actually took profit on Telstra yesterday and moved into DN1 for a similar reason that we sold out of Zero. So a great company. They've just reported their metrics are going phenomenally well, and their financial or their operational leverage is really working at scale, and that's what we're going to look for in a technology company. As Shawn said, we took a 90-odd% profit on that position to put some cash and flexibility back. We'll revisit Zero. We've got little doubt that we'll not own Zero again. But from a risk reward point of view, would we be buying it up around these $200 all-time high marks? We wouldn't. So we've taken it off in terms of Zero. You made mention of WiseTech, Shawn. This is actually one I just want to highlight because it's had a few issues in the past 12 months. We're all across that. We've written about it, but we've still gone and bought the stock. It's down 1.5% today on broader tech weakness. But there's not often you get the opportunity to buy into a growth story like WiseTech over the next 3, 5, 10 years. I think it's going to be a significantly bigger company than it is today. And they've got some interesting announcements that I think are not too far away in terms of their product suite, new products, and how that is going to translate into earnings over the coming 12 months or so.
Exactly. I think coming back to the issues, to me, Richard White, the founder, he's really focused, he's really driven. And even though some of the people in the market thought they overpaid for their recent acquisition, I think it was $3.5 billion. It was a big number. I just feel like it's showing us, as far as they're concerned, it's business as usual, and business as usual for WiseTech is very exciting.
One of the things I draw listeners' attention to is just the syndicate of banks that were happy enough to finance $3.5 billion. So, banks are generally pretty conservative in how they think about lending money, particularly to technology businesses. So they've been able to debt fund this acquisition. So they haven't had to issue new equity. It's their largest acquisition, but they've done a bunch of them, and they've proven to be able to integrate those acquisitions and make them work. So it feels, logistics are a really complicated area. Logistics supply chains are a really complicated area. And WiseTech is doing what I think is, putting together a really good suite of products that are becoming really ingrained in the supply chains, the logistics operations of individual companies. So that's one we like in the short term. I think this is a really interesting play in the short term. Was there anything else in the tech space that you wanted to cover? Catapult was a good one this year. And also RPM is one that we've added to recently, which is RUL.
No, two great companies. And I think the other thing that we'll just mention, because I know it's on everyone's lips, is AI. AI is going to be something we talk about a lot over the next 6 to 12 months. It was interesting today to hear that Elon Musk's company is burning through over $1 billion a month. We know that Meta platforms, or the old Facebook, and most people would still remember it, they're building up a super team of very, very high intelligent people to run their AI. They're paying massive sign-on bonuses. Everyone is throwing an absolute fortune at AI. My gut feeling at the moment is everyone that gets to use that suite of what comes on the market is going to do very, very well. I think some of the companies that are spending a fortune to try and be first, if they're not first, they're going to probably end up suffering. And it's something we will really be watching closely and keeping our finger on the pulse. It's a fascinating subject, which will, in lots of ways, dominate markets going forward. And I reiterate, companies that can benefit from the use of AI, as opposed to necessarily the ones that are actually developing it, I think could end up being the ones at the front of the whole curve.
The place that's probably got the most exposure in AI, well, it does, is the international equities portfolio. You can jump on portfolios, navigate down to the international equities portfolio. The companies I'll just highlight that are obviously influential in AI. Microsoft has been a core holding in the portfolio for quite a while, but would absolutely still be happy to buy Microsoft at current levels. This is going to be it's probably the one of the safer, lower risk ways to play AI. You know you're going to get exposure to AI by holding Microsoft, and you know you're going to get exposure to a broad suite and type of customers. They're not relying on one particular area of AI working, and they've got a huge amount of balance sheet strength to be a winner in AI. The other one that I think is underestimated, and we've bought this more recently, is Alphabet. Obviously, concern around AI replacing the traditional Google search. So if you want to dig further into international equities, you can click on the company code and all the same data is available for international equities. So it's not like Market Matters is an Aussie only platform. It is I've got some delay here with the charts just because of where I'm operating in the speed of the internet. In terms of Google, so you will notice that AI-driven search is now replacing those sponsored links at the top of search panels. That's having a huge positive impact on the number of searches happening on Google. So when a lot of people thought that Google was going to be a loser, or Google search was going to be a loser from AI, I think Google search is now becoming a visible or an identifiable winner in terms of that. Let's get closer to home, Shawn.
Just one thing, James. Can you go back up very quickly?
Yep.
To people that aren't familiar with the website, if you are searching for a US company, you have to make sure that you put the US after the code. So as James had up there, it was GOOGL space US. If you go through the search at the bottom.
If you go through the search, so you can search Google, that'll bring up that will bring up, it's actually Alphabet.
Yeah. Okay.
Bad
example.
So you'll find that on the site, you can either type in a description at the top of the site, or you need to go, if you're typing it down the company code, you need to go down the company code, or you can go through the portfolios to see what they're holding and click on the links within the portfolios to navigate to the individual stocks. The other interesting thing is that from a report standpoint, there'll always be codes within the report that you can click on, and that will direct you to the website and to the individual stocks that we're talking about on the website. So it will take you directly there. Metals and mining, Shawn. So why don't we start with it? What everyone's interested in at the moment is probably gold, aside from oil.
Gold. No, gold's absolutely fascinating. Gold is something we've been talking about for a while. We probably, in hindsight, weren't quite nimble enough with evolution. I wish we'd got out, but wish is one of those things you can't make any money from. At the end of the day, we've seen gold pull back 3%. We're very, very bullish gold in the medium term. It's very important to remember that. Gold's only pulled back 3%, but the gold miners, Evolution, and Regis have both already dropped 20%. So what tends to happen?
So there's gold. That's US dollar gold right there on the screen in front of you. Aussie dollar gold is obviously had a phenomenal run as well, and now I'll just jump into Evolution and resource. Yeah,
exactly. So it's very common that mining stocks lead the underlying metal. So as far as I'm concerned, we're laying traps in the next 6 months where we increase our Evolution mining position, or whether maybe we even get more reckless and buy into something like Regis, or we might put Regis into the emerging companies portfolio. That's James and I will sit down and discuss. It's a far more leverage, higher beta play. But actually, ironically, they're both down 20% off their highs. All of a sudden, they've got some downgrades, just like everyone was very, very bullish. Gold, about 4 or 5 weeks ago, we pointed out it was the most crowded trade over there, or out there, I should say. Crowded trades are dangerous places to be. The gold sector is a crowded trade, even though it might be the right trade. Analysts are suddenly all backing off. Gold selling off very, very quickly, or the gold sector, I should say. I wouldn't be surprised to see, for example, Evolution test 750, maybe poke its head under. And then what you'll probably see is the actual gold price might drop $100 or $200, and the likes of Evolution and Regis don't move. When that sort of price action happens, in our opinion, it will be looking for a low, and it's time to increase exposure to the gold sector. So to me, and to James as well,
pullback.
buy the pullback in them, and the likelihood is it's starting early, and when the actual precious metal goes, don't expect the gold stocks to go as far. They're already doing it now.
All right. So two of the main drivers of portfolio performance over the past 12 months has been evolution, number two, and our number one performer in the active growth portfolio was Sandfire. In the copper space, we've traded a couple of times. Just to wrap up the comments on gold, I mean, in my view, in the very short term, this is going to be it's been a crowded trade. When everyone's talking about it, we become concerned about it. And the other crowded trade that everyone's talking about and consensus trade is short the US dollar. So, the US dollar is going lower. There's a bunch of reasons for that. A loss of confidence in what's playing out in the US, a loss of confidence in leadership, and so on and so forth. I think that is also a very consensus short trade, short thesis. So if the US dollar, which is a crowded trade on the short side, does bounce, and there's reasons that it could bounce. You think about what's playing out in the Middle East. If oil prices continue to rise, that we'll start to get inflationary concerns again, which means US interest rates may not be cut as aggressively as the market had forecast, as we suggested earlier on. Then the US dollar could actually rally in that environment, and that could be that could correlate with a gold selling off further. But I still think the short US dollar trade, long gold works over the medium term. I think in the short term we've just got too bullish on gold and too negative in terms of the US dollar, Shawn.
Exactly, and that's where investors and subscribers need to identify their time frame. If you're going to buy gold stocks here, we think you'll be looking good in a year or two's time, but you've got to be happy to absorb a 20% pullback like we're seeing now without panicking.
So edge in the positions and edge out of positions would be one of the things that how we would manage those things. We're also not we're not shy of taking profits. I mean, a company that we really like, Xero, we took profits on yesterday. A company we really like, Telstra, we took profits on yesterday. They've had phenomenal upside moves. Gold, to me, is very much a macro play. So if the underlying gold companies are delivering operationally, then it becomes a macro play. So you've got to have your finger on the pulse on the macro side, but you've also got to be prepared to stand up against the prevailing sentiment. So everyone's bullish. You've got to be prepared to go against that trend. Everyone's bearish. You've got to be prepared to stand up and go against that trend. They're not easy calls to make, and we try and provide the evidence and the information behind our calls when we make it. But we're making real-time calls in the market. We're making real-time calls on our own portfolios, and we're writing about those and publishing them on the Market Matters website. So that's what differentiates, or one of the reasons that differentiates Market Matters from everyone else. There's a lot of theoretical model portfolios that get around where purchase prices and performance are more theoretical than anything else. These are real portfolios that we own. We're trading in these stocks, and we're writing about those stocks on a daily basis. One of the good performers, Shawn, this year has been Sandfire, copper company.
Yep, exactly. And we wrote about it yesterday on Wednesday, which is yesterday, and we trimmed our position. The same thing. We scaled out of it. And if you go back over the last few years, you'll see we've scaled in and out of Sandfire and Evolution a few times. It's not new. It's not something we've done before or haven't done before.
So you'll see that on the website. So the last buy in Sandfire was back at the start on the 7th of April when the tariff situation was unfolding. We bought Sandfire again because we had held it and we'd sold it at about $11.20, and that was in March, which was great timing to get out of it. In April, we've come back and we've bought back in the Sandfire. And if you go and read the opinion, we outlined why we're buying back in the Sandfire at that time. So you can go and look at the history of our actions, if you like, as one of the things that the Market Matters members enjoy. And yesterday, you rightly pointed out, Shawn, we have trimmed it back to a 3% weighting. The other important point I'd make around our trimming or our moves in portfolios is that we started with a 4% position, but that position was up 45% since entry. So obviously the position size had increased accordingly. by that amount. So when we put an action out, although we're trimming from 4 to 3%, it's going to be a bigger portfolio trim in practice. So that it'll be more meaningful than a 1% trim. It'll be go back to a 3% target in the portfolio, and that's the specifics we get around our alerts, etc.
Exactly, and that's again, Samfire's a stock we like. We talked about it yesterday. We talked about the fact that BHP and Evolution, their copper aspects are almost being ignored. If we get a pullback in copper, or if we see Samfire drop another 5 or 10%, there's no reason we won't top it back up. Probably more than 10% than 5%. They're volatile. They're volatile, cyclical commodities that often move. It's that chart that James just called up show you.
Yeah, exactly right. So copper futures on there is trading at $4.86 US a pound. We think it goes over $5, but that's not a huge call now. The underlying drivers for copper, I think, are very clear for all to see. So obviously you've got global electrification coming through, but if I look out, so the demand side is improving. But if you look out from a supply side, we've got supply constraints over the coming years, and the overall market moves into deficit. So to me, copper is it's a must-have in portfolios. We won't always have it, but it's a must. It's an underlying commodity, an underlying theme that we remain very bullish on, and we're amending our positions based on that bullish view overall. We do have Freeport in the international equities portfolio, Shawn. They've lagged what we've seen in terms of Sandfire. Sandfire's been a huge outperformer.
Exactly. Again, some of the currencies we've seen a bit of money pull out of the US market over of late. Obviously, again,